Join the club of the richest 1%. By employing the strategies in this video, you can become rich and established and join the club of the richest 1%.
The knowledge and strategies in this video are rooted in Jacob Nayman's extensive experience, distilling more than a quarter of a century in his role as a leading investment and economic advisor to some of the world's wealthiest. Infusing your life with the financial strategies outlined in this video will enable you to achieve the most important goal of the 21st century: financial independence.
The only situation in which you should be willing to tolerate higher risk is one in which you expect to be rewarded with higher profits. In wealth management, you have a powerful and effective tool to reduce your portfolio risks while maintaining higher rewards. This tool is called asset allocation. Asset allocation. Asset allocation is an investment strategy that aims to balance risk and reward by apportioning a portfolio's assets in different investment channels: stocks, commodities, bonds, and cash. How does asset allocation reduce risk? The returns of stocks, bonds, commodities, and cash do not move in unison. Market conditions can lead to one asset class outperforming during a given time frame, but cause another to underperform. This kind of market behavior balances and reduces the volatility of the entire investment portfolio. For example, you can invest your money by applying the rule of thirds to asset allocation. Invest 1/3 in real estate and commodities. Invest 1/3 in stocks and bonds. Invest 1/3 in money and its equivalents. The main points. Asset allocation is a powerful tool to reduce your portfolio risk while maintaining high returns. Greater risks should be taken only if the potential return is high. If not, the risk should be avoided.
Is predicting your economic future a riddle wrapped in an enigma? Not quite. It's about creating it. Financial practices shared in the earlier segment, courtesy of financial expert Jacob Nayman, are your toolkit for securing that future. But here's the catch. Knowledge isn't the ultimate prize. It's action that truly counts. The upcoming segment aims to spark that drive, that motivation within you to implement these strategies. So take note and remember, in the grand chessboard of finance, it's not the player who knows the most moves, but the one who actually makes them, who wins. This video contains valuable information. Use it.
Imagine losing 80% of your investments in a single day. That's what happened to investors who put all their eggs in the tech basket during the dot-com crash in 2000. They watched their fortunes dwindle as the tech bubble burst. A clear testament to the dangers of betting everything on a single sector or company. It was a harsh lesson on the volatility of markets and the risks of not spreading investments. This is why portfolio diversification is crucial. But what exactly does it mean? Portfolio diversification in its simplest form is spreading your investments across various assets. Let's think about it like this. You wouldn't want to put all your eggs in one basket, would you? Now imagine those eggs as your hard-earned money and that basket as a single type of investment. If the basket falls, all your eggs, your money, could break. That's where portfolio diversification comes in, spreading your eggs across different baskets. In the world of investing, these baskets are the diverse types of assets you can invest in, like stocks, bonds, real estate, and commodities. This way, if one basket takes a tumble, you don't lose all your eggs. But diversification isn't just about reducing risk, it's also about potentially increasing returns. By investing in a variety of assets, you're not only protecting yourself from the downturns of one market, but also taking advantage of the upswings in another. This balanced approach can lead to more consistent returns over time. There's no one-size-fits-all solution, though. The key is to find the right mix of investments that aligns with your financial goals, risk tolerance, and investment horizon. It's like creating a well-balanced meal from a buffet of options. So, diversifying your portfolio can help you weather financial storms, but how ready are you to start diversifying? Diversifying your portfolio isn't just about buying different types of assets. It's about buying the right assets at the right time. Now, that sounds simple enough, but the challenge lies in the details. You see, diversification isn't a one-time affair. It's a continuous process that requires careful research, keen understanding of market trends, and regular portfolio rebalancing. Imagine you're a chef crafting a perfect dish. You can't just toss in ingredients willy-nilly. No, you need to know when to add what, in what proportion, and adjust along the way. It's the same with diversification. And then there's the question of knowledge. Not everyone has the time or expertise to keep a close eye on the ever-changing financial markets. That's where professional advice can come in handy. Financial advisors can help steer you in the right direction, making your diversification journey a little less daunting. Are you ready to diversify your portfolio and potentially safeguard your financial future?